It's chaos in China. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, as China's economy implodes, it's a shocking black swan event that nobody saw coming. I'm going to show you why Beijing is so desperate, why what they're doing isn't going to work, and why China's economy is on the brink of an all-out recession that's going to lead to a global financial crisis. Now let's over to Bloomberg, where we picked today's story up with the headline is why China is trying to curb short selling of stocks. It's simply because their stock market is about to implode. It's continuing to decline. China wants to do everything they can to stop it, now looking at an all-out ban of short selling. As the country's market regulator forced investors to put more money aside as surety against short-selling positions, and the country's biggest stock lender halted the practice of loaning out shares. The measures add to earlier restrictions that have failed to halt the decline. And this is something we see countries do from time to time when their equity markets go down. They want to put a halt to it, and they believe it's the evil speculators that are driving stocks down, so they come in and do whatever they can to stop the short selling of equities. But what they don't realize is these policies just don't work, and there's other reasons why the equity markets are falling. In this case for China, it's because their economy is headed on a downward spiral. And at one point in January, more than $6 trillion had been wiped out the value of Chinese and Hong Kong stocks from their peak in 2021. As history shows that clamping down on short selling rarely provides the market with more than a short-term boost. And you can think about why countries would want to make this move, and it has everything to do with the wealth effect. As people lose money, they tend to save more and spend less and pay off debts, and that's not what you need when your economy is already headed down. But for China, the issue is with their equity market. It is continuing to decline. Here you can see in black going back to 2020. It's been on a steady downward move. Meanwhile, the MSCI All Country World Index continues to head higher, of course, with that being led by the U.S. major equity indices. And something that's also heading higher, because you don't have to worry about being on that black line, is our close of business results. Look at this. As of Friday, our CTA Timer Pro, our machine position report now has 2 open trades. They're both up. We just added one. Our Momentum Timer Pro now has 9 open trades. 8 of them are up, that should say, at an 89% win rate. Look at this. We just got stopped out for a net 3.96% gain with a couple trades on Friday. And how do we do that? How do we find these great trades? Well, we look when machines are deep short, and our report analyzes machine positioning across a wide range of securities every day. And when we find the price is rallying against it, our report flags that trade, and then we review it. And how about Momentum Timer Pro? Maybe you like to trade momentum. You like those technical signals like the RSI and the MACD, but you find yourself all over the place. Look at this. On Friday, stopped out for a gain on GDXJ, and here we see how do we look at momentum. We look at it different time periods of over 1, 3, 6 month and daily, and when we see a big pullback in the monthly signal and momentum shifting, it flags our report. And then what we do is we give you the daily report, the tradable signals. I review each and every trade to tell you which ones you should do and give you my opinion on the stop loss levels. We track those trades every week. We follow up on the returns, and every week I update all subscribers on the stop loss level. And here's the best part. You can get on for 30-day free trial. This isn't sit in front of your computer all day and trade. Put your trades in the morning and go about your business. We make money and we do it well. Links in the description below. You've been looking to get in on the market, or maybe you think it's coming down. You want to know where to move your money. We'll tell you that too. Earlier this year, China's largest brokerage, a state-controlled CITIC Securities, stopped lending stocks to individual investors and imposed additional conditions on share loans to institutions. And what we see, China Securities and GF Securities ban clients from using margin loans to buy and return stocks they sold short, as this behavior was seen as increasingly risky by allowing a client to double down on leverage. And of course, Beijing saying no more of this, and yet it has no effect on the markets. I want to look at the short interest here, and you can see it's in decline. It's had no ability to stop the decline in Chinese equities, and simply because as an economy shrinks and contracts, well, of course, that means revenues and profits are coming down, and equity markets do as well. You can't put an end to that no matter what the government does. And even if they try to buy equities as they've done, it just doesn't work. And here you can see the short interest going back at where it peaked somewhere in 2021. It continues to decline. And despite the decline of short interest and, of course, these speculators getting pushed out of the market, it is not keeping China's stock market from continuing its decline. It's a strong indicator that the rest of their economy is headed into a recession. And market participants say the curbs are unlikely to give stocks a sustainable boost as the market's trajectory hinges more on an economic recovery. There's the key point, and an improvement of earnings. But when your economy is headed lower and consumers are spending less, earnings are going to decline. The market is going to price that in. That's exactly what we're seeing. And now all of a sudden in the U.S. equity market, we're starting to see the market price that in after an impressive run-up, suggesting that maybe the U.S. market is overcooked and likely to head lower as well. In a Chinese stock boom and bust cycle back in 2015, the government restricted short selling to force out day traders whose short-term selling and buying was seen as fueling an abnormal fluctuation in the market. However, the market continued to slide in the following months, again providing evidence that as governments step in to control the equity markets, it just doesn't work. Because the issue with China has everything to do with their economy, and you can just see how bad it is and how close it is to a recession. Let's take a look at what's going on in their housing market. And as we see, China's GDP growth unexpectedly tumbles. And that doesn't really make sense of unexpectedly, because when you see a decline in housing, and remember, housing are large parts of major industrialized economies. When they slow down, the economy goes with it. And this happened as new home prices plunged the most in 9 years. Remember, that's not supposed to happen. Perhaps it should be a two Black Swan event show. First on short selling ban, now as we look at, of course, the real estate market in China continuing to crumble. Their economic growth collapsed to just 4.7% year over year in the second quarter, missing all but one economist's forecast. And this is an issue because the GDP, which rose 5.3% in the first quarter, had been expected to rise around 5.1%. And now it's fallen to 4.7 and likely to head lower, as this is the lowest growth since March of 2023. And you have to keep in mind, China needs very big numbers in GDP growth to sustain its economy. And as it continues to decelerate, it's just an indication not only of a lack of internal demand in China, because you have to think Chinese consumers are seeing a broad slowdown of the global economy, because as the world's largest exporter, when demand for their factories declines and their services decline around the world, well, they're going to cut their spending because they see what's coming. A lack of demand means, of course, fewer hours to work, less jobs, and that means consumers start to cut back in a big way. What we're seeing in China is just a symptom of what's happening around the world, and that is a global recession is brewing. And China has grappled with weak consumer demand and a prolonged property slowdown, prompting greater intervention from policymakers in recent months, indicating how desperate they are getting, and they just don't know how to solve the problem. They think banning short selling is going to work. The issue is it's not going to work. It's only going to be a blip in the issue of a declining equity market. The bigger focus should be the economy, which the government has no answer. Because in the absence of a bazooka stimulus, both on the fiscal and monetary side, which China is not ready to do, it is unlikely that anything will change and growth will continue to cool quarter after quarter until there's a brutal recession and or civil unrest, both likely to happen in China. Because remember, you look at their banking system and they're heavily leveraged into the property sector, which is crashing. China's trying to keep its banks solvent. When, of course, the property sector finally falls off the cliff, it's going to pull the banks down. You're going to watch, of course, people be unable to access their money. It's going to trigger massive amounts of civil unrest. And if you think this can't happen here in the U.S., keep in mind that our large or mid and small size regional banks, that is, are heavily leveraged in the commercial real estate space. When that starts to finally break and come crashing down, watch those banks hemorrhage and U.S. depositors panic in a major way. And separately, new home prices in China fell 4.9% year on year last month, the fastest pace of decline in 9 years. And we told you this was going to happen, and it's going to continue accelerating to the downside, while new construction starts and property investment were down a whopping 23.7% and 10.1% respectively in the first half of the year. There's nothing that indicates that that is going to change at all. There's no soft landing going on in the global economy. There's no indication that China's economy is turning around. They can do things like banning short selling. The bottom line is, by the time the Chinese government reacts to what's really going on there, it's going to be too late. And Beijing has set a full-year economic growth target of about 5%. Unless they launch a bazooka stimulus, it has precisely zero chance of hitting it, as China is leading the world into a recession. Of course, we note that Germany's industrial sector is in a depression. The U.S. economy is now facing rising unemployment claims. We're seeing all the symptoms of an early-stage global recession that is going to trigger an all-out financial crisis, and it has a lot to do with credit. And as we look back to China, their credit growth is the weakest on record as demand languishes, and this is an issue because in a debt-based economy, you not only need a constant expansion of credit, you need credit to expand to begin with, to create new money into the economy, to create growth and hit those targets. Of course, what we know, not only in the U.S., but governments around the world led by the central bankers are constricting the creation of credit, China being one of them as well. And the stock of aggregate financing, a broad measure of credit, expanded 8.1% from a year ago. Here's the key: the slowest on record in data going back to 2017. So you want to know why China's economy is slowing? It's simply because the banks aren't expanding credit. And what have we noted is happening in China at the banking level? The banks are buying bonds, and long-term bonds in a big way. And what is Beijing doing? Telling the banks, look, there's a bubble here. Interest rates are going to go up, bond prices are going to go down, and you're going to get smashed. The reality is the Chinese economy is slowing, growth and inflation expectations are coming down, and despite attempts to ban short selling and try to dumping bonds on the market to bring rates up, the reality is we're seeing China's economy right on the edge of an all-out recession. And the net increase in aggregate financing was 3.3 trillion yuan, and this is below the 3.4 million forecast. Meanwhile, loan growth also hit a record low, as the stock of outstanding bank loans climbed 8.3% from a year ago. Again, here you see the slowest pace in data going back to 2003. And in an overheated economy, if you want to maintain asset prices, this is not only just in real estate, but in equities. And I want you to prime this for what's going to happen here in the United States. If there's not enough money being created by the economy to sustain the equity market, it too is going to come down, and people will say they want to buy. The problem is they just won't have the money. And here you can see what central bankers around the world are doing, including China, and that is keeping short-term interest rates above market expectations. And when you do that, you invert something called the yield curve. That's shown in blue. And what we're looking at is when the blue line is below that horizontal black line, you see the 2-year yields are higher than 10-year yields. And this doesn't make sense, and it shouldn't make sense, because that is a sign of man's intervention into the bond market. And when you do that, banks borrow at the short end of the curve, lend at the long end of the curve, and when it's inverted, well, they don't make money on the interest rate spread, and that's not good for banks, because look what happens when you see these inversions and then yields falling as the curve steepens. Look at what happens to commercial industrial loans. This showed, of course, U.S. data in red on a year-over-year rate of change. So when you see these inversions, it's bad news for the banks, and what it actually predicts is a collapse in lending. That's exactly what we're seeing in China, and soon going to see here in the U.S. That's going to bring our economy down, and of course our equity markets as well, along with interest rates, but not in the way that, of course, the policymakers want interest rates to go down. They want them to be pulled back on the fact that the economy is moving in the right direction. Soon they're going to find out it's not. And while June is traditionally a strong month for borrowing, as banks tend to extend more credit at the end of each quarter to meet lending targets, again, that's set by the government, a prolonged real estate slump has curbed demand for credit among consumers and businesses. That's not necessarily the case. Consumers and businesses always want more credit because there's not enough money to pay on all the debt. The issue is the banks don't want to lend. And local governments have also been forced to cut back on their off-balance sheet borrowing as Beijing seeks new ways to drive economic growth. And this is brilliant, because I want you to see how the government doesn't understand their own economy. that won't rely so much on expanding credit. Well, guess what, Beijing? Guess what? That is exactly how you expand a debt-based economy, is through the expansion of credit. You need more debt. And you can see the evidence that banks don't want to lend. They don't want to lend in China. They don't really want to lend here much in the U.S. either. And what you can see here is the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes is here in the U.S. Anytime that blue line moves above that horizontal black line, that means on-net banks are tightening standards, making it more difficult for consumers and businesses to get loans. And as they do that, look what happens to the credit creation mechanism. It can sustain for a little bit, and then it starts to fall. And here we can see it's just coming back above the positive line here a little bit, but it won't last. As interest rates come down, banks will further tighten lending standards, and you'll see this roll over, and that'll be game over for the U.S. economy as well as economies all around the world. And China's economic outlook continues to show a mixed picture. While exports have been very strong, with data on Friday showing a surge to the highest level in almost 2 years, factory activity shrank for the second straight month in June, and consumer prices cooled, spurring calls for more policy support. So what we're seeing here on the export side is likely the seasonal preparation for eventually the back-to-school season and some holiday season, as companies look to front-run that. Remember, they do actually remember not having the right inventory when they needed it. So you're looked to see, of course, some of this being seasonal, but notably factory activity, as it says, shrank for the second straight month. So while exports are up, it's not a big boom. And shortly after the data, the PBOC-backed Financial News published commentary saying that a slowdown in credit, there's a key one, and money supply growth, there's another one, does not mean the economy is weakening. No, that's exactly what it means, because in a debt-based economy, again, you see a deceleration of credit, slowing money supply growth. Those are all indications that your economy is turning the wrong way. They don't get it. It called for markets to refocus less on these indicators and pour more attention to interest rate adjustments instead. Of course, what the interest rate market is saying in China, as long-term rates continue to fall, that growth and inflation expectations are coming down. And we can again look at what this means for the economy. Here you see we'll keep the commercial industrial lending data, that on a year-over-year rate of change in red, against the GDP growth. Again, we're looking at U.S. data here, that also shown on a year-over-year rate of change. And what you can see is decelerations in credit match decelerations in the economy virtually each and every time. This time no different. We can expect the U.S. economy continue to slow down, and if credit takes a big move to the downside, well, watch out. Our economy also headed into a recession. And of course, we note that we're seeing this in the commodity space, and for our subscribers, it's an opportunity, because when commodities come crashing down, they're going to have the signal to buy at deep discounted levels. And look at this, China's commodities imports ease on June, this on a sluggish economy. So there's the evidence that, of course, the PBOC doesn't want people to realize. And over the first 6 months of 2024, the world's top importer bought less crude, soybeans, edible oils, meat, and rubber compared to last year. That means demand's coming down, and that's unusual. Markets that often see record demand each year as China's economy expands, indicating that exactly what we're seeing here in, of course, the Chinese equity market, in their lending growth, in the interest rate market, is demand is coming down. That means consumers want less, they're importing less. Even some metals importers have also started to slow, while growth in coal purchases weakened substantially. Again, watch out in the commodity space here, that this will be opportunity at some point. Even unrock copper purchases slipped to a 4-month low after record international prices in May suppressed already weak demand. There's that weak demand term again. Concrete imports increase, however, despite tighter global supplies as smelters continue to expand capacity. Again, you see demand coming down here across the board, and that means, of course, consumer prices facing the same issue as they inch up, but deflation pressures continue. We're going to see consumer prices here in the U.S. fall as well. But look what's happening in China, because what happens there eventually gets here, particularly on the producer side. And here we see China's consumer prices eked out another small gain in June, but hovering near zero for a 5th straight month. A sign that deflationary pressures continue to impede an economic recovery, so any signs of growth are not showing up in consumer prices. However, factory gate prices remain stuck in deflation, as they've been since late 2022, with the producer price index sliding 0.8% from a year earlier, matching the result expected by economists. The index declined 1.4% in May. And keep in mind where, of course, we see consumer prices go in China and producer prices, it's going to affect particularly U.S. consumer prices. And we know that as loan growth goes down, here you can see consumer price index in blue goes with it. You see the beautiful relationship here between the two. When the economy is not expanding because you're not expanding the debt markets, that means you're going to see, of course, deflation. Right now, we're seeing a little increase in lending, but if consumer prices continue to head lower, well, look for, of course, lending demand to turn around to the downside in a major way. And the problems related to deflation can be serious, potentially leading to a downward spiral as people hold off on purchases due to expectations that prices will continue to fall. That could dent overall consumption and spill over to businesses. Here you see the risk of deflation has not faded in China. Domestic demand remains weak, and in the long run, China will need a rebound of domestic demand to drive the economy, and that, my friends, is an absolute understatement as we now see that China's economy is on the brink of an all-out recession, if not complete financial crisis. Beijing doing what no one thought they would step in and do, now looking at an all-out ban on short selling as the government tries to put a halt to this. None of it will work. Of course, what we're about to see is the biggest black swan in China's economic history. It's going to take the whole country down in a major way. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.